Hello and welcome to this session. This is Professor Farhad. In this session, we're going to look at the statement of cash flow for proprietary funds. Basically, this is a governmental accounting course. So the first thing we need to know is government are required to prepare statement of cash flow for proprietary fund. Though don't confuse this with governmental funds. Governmental funds, there is no cash flow statement for the governmental funds. Hopefully you know what the governmental funds, the general fund, the special revenue fund, the permanent fund, and the debt service fund and the capital project fund. Now why not? Why don't you think the governmental fund would need a cash flow statement? Well, hopefully you know why. Because they use the modified accrual. Okay, and the modified accrual is very close to the cash basis. We don't use long-term assets, we don't use long-term liabilities. Therefore, the income statement, to a great degree, it's very close to cash that there's no need for a cash flow statement. Now, for the proprietary fund, remember, for the proprietary fund, we use accrual, full accrual accounting. Therefore, we need to prepare a cash flow statement. Now, bear in mind, the way government and for-profit businesses operate, they differ. They differ a little bit, okay? So, government typically characterize their activities either as operating or capital. So operating, we all know what operating is, or hopefully we know what all operating is. It's what generate our revenues and incur our expenses on a regular basis. Now, what is capital activities? Capital activities, those involving the acquisition and financing of long-term lived asset. So capital means is when we acquire assets, property, plant, equipment, okay? Those accounts, they're often budgeted and accounted for apart from operating activities, especially when it comes to the government. So this is the big picture. Now, how does FASB prepare the cash flow statement? Hopefully we remember this. FASB has 3 sections. One is operating activities, and that deals with day-to-day operation, revenues, and expenses. A cash flow from investing with FASB, let me clarify this. FASB means private. Let's not call it private. Let's call it for-profit businesses. For-profit businesses. Although non-for-profit follow FASB, but I'm just going to say for-profit businesses. In other words, regular businesses, not government. Cash flow from investing. Cash flow from investing, when we talk about for-profit businesses, they deal with long-term assets, when they buy and sell their long-term assets, and when they buy and sell long-term investments, such as bonds and stocks. And cash flow from financing deals with issuing stocks, buying back your own stock, issuing bonds to borrow money, issuing notes, so on and so forth. So hopefully you're going to start to see that, for example, a government don't have stockholders, therefore they don't issue stocks. But this is for FASB. Now for GASB, they're going to break the cash flow statement not into 3 but 4 categories. The first category, it's operating activities. And to a great degree, this category is similar to the FASB categories. Basically, your income statement, what do you do on a day-to-day basis to generate revenues and to run your business, which is incur expenses. Then we're going to have the second section called cash flow from non-capital financing activities. So notice what it reads. It is non-capital financing activities. Financing is how we raise money, okay? Capital means how we acquire asset. But here we're dealing with non-capital financing and financing activities. So this is how we raise money, but not for capital purposes. Capital is when we buy assets, long-term assets. Then we're going to have a section called cash flow from capital and related financing activities. Here it's capital and financing. In other words, we are raising money to finance our capital expenditure. What are our capital expenditure? Equipment, property, plant. This is what we are looking at. So notice the government worries about capital and non-capital. So they break down capital into, they break down their investing. Basically, if you want to compare 2 and 3 to the private, 2 and 3 are similar to the investing, because under the investing, as I told you, this is where the private business acquire P&E, property, plant, and equipment. For the government, what they say certain financing, okay, they are to acquire capital investments, and certain financing are for other purposes other than capital. And what is financing? And notice here, it says financing under the private FASB categories. Under financing is how we raise money. So the government says we could be raising money for capital purposes, which is to acquire property, plant, equipment, or we could be raising money for non-capital purposes. So don't let the words confuse you, okay? So financing means how we raise money, how the company raise money. The private company, they issue stocks and they issue bonds, right? Government, they either raise money to buy capital asset or they raise money for purpose other than capital asset. And the fourth category is called investing. Again, here, don't confuse investing with this activity. Here, investing deals, and we're going to see, with buying and selling investments. So investing here really mean only strictly investments. So when we buy and sell investments in treasuries and treasury bonds of other government. Okay, so this is really investments. Here, when we say cash flow from investing, we also involve investments as well, long-term investments. And don't worry, I'm going to go over 1, 2, 3, and 4 a little bit in detail to tell you what goes under each category. But the first, I want to highlight a couple things that differ between GASB and FASB beside the categories is how they treat interest, how GASB and FASB treat interest. So interest pays as a financing activity and interest received as an investing activity rather than operating. So under FASB, let's look at FASB first because we're comparing everything to FASB. FASB state if you receive interest, it says that's operating. If you pay interest, that's also part of your operating activities. So FASB state when you receive interest, when you pay interest, it's basically part of operating your business. Okay, although there was a big disagreement that interest paid, especially interest paid, should be a form of financing, because when you borrow money, you're financing yourself, therefore the cost of money should be financing. FASB disagree. So under FASB, interest received and interest paid is operating. Okay, interest paid as financing activities. So here what's going to happen under GASB, interest paid as financing and interest received as investing. So when you pay interest, it's considered a financing, and when you receive interest, it's considered as part of your investment. Part of your investment. Now under financing, we're going to break it down into capital and non-capital. Remember we talked about this, because they break things into capital and non-capital. Okay? So whether interest is classified as capital rather than a non-capital depend on how the underlying debt is classified. So if you borrowed money to buy an asset, it's a capital financing. If you borrowed money for other purpose other than constructing or buying an asset, it's non-capital. And again, we'll look at these categories a little bit further. So GASB maintain that by classifying interest received and interest disbursed in the same categories as purchases and sales of an underlying securities, government provide a more complete picture of the cash flow associated with financing and investing activities. So what they're saying is, if you receive interest from investing, it should be investment. If you borrowed money to buy an asset, it should be financing, capital financing. If you borrow money for other than buying an asset, it's a financing but non-capital. That's all. They want to kind of take the interest and associate it with a specific category. Another, beside interest, the method that we used, GASB want us to use the direct method, okay, rather than the indirect. Now FASB doesn't really care, we can use both, either or, but GASB, they want us to use the direct method. Although you have to use the direct method, you still have to prepare a reconciliation for the indirect. And another significant departure from FASB, GASB mandate the government report their cash flow using the direct method, which is also, FYI, the IFRS, the International Financial Reporting Standard. They want you to use the direct method. The direct method, how does the direct method work? We'll look at an example. Explicitly report the operating cash flow in a way that makes clear their sources and their uses. So basically the cash flow, cash received from customers, this much, cash paid to employees, this much. So it's the direct method. Hopefully you know what the direct method is. The indirect method is a little bit different. The indirect method, you start with net income and you reconcile to cash provided or used in operation. And by the way, hopefully you also know this, that only the operating section differ between the direct and the indirect method. Only one section differ. The other two sections, there is no direct and indirect method. So that's another distinction. Now we're going to go through a list of laundry. Tells us what goes under cash flow from operating, what goes under cash flow from non-capital financing, what goes under the cash flow from capital financing. Starting with cash flow from operating activities. So when we say cash flow from operating activities, where does the government brings that cash flow? Well, obviously, sale of goods or services, including the collection of receivable, that's considered operating activities. Grant for operating activities. If you receive a grant, and that grant, notice here, for operating activities. You could be receiving grant that's not for operating activities. You could be receiving a grant to buy a building or to expand. Then that's not operating, okay? So grant for operating also, that's an inflow. Receipts from interfund services provided by other funds or from interfund reimbursement. Again, here we are dealing with operating activities. All other cash receipts not defined as capital financing or investing. So if there's anything else, that's not capital, that's not financing, and that's not investing, which we're going to see what those other categories are. Outflow of cash under operating activities would involve payment to acquire material for providing services, including payment on accounts payable, obviously to pay for our suppliers because we're operating, payment to employees, grants to other government for operating activities. If you grant other governments a grant for their operating activities, that's considered an outflow of cash under operating. Payment for taxes, duties, fines, and other fees or penalties that deals with your operation, obviously. Payment of interfund services used by other funds, including certain payments in lieu of taxes. That's also operating. All cash payment not defined as capital, financing, or investing. Those are all outflow of operating activities. Let's take a look at cash flow from non-capital financing activities. So you are bringing money in or paying money out, but it has nothing to do with operation and it has nothing to do with capital. Capital means acquiring assets. 1. Inflow. Money coming in. Proceeds from bonds. You issue bonds, you issue notes, you borrowed money or other debt. Notice I highlighted this. Not clearly attributable to the acquisition, construction, or improvement of capital asset. So you're borrowing money, but not to buy assets. Long-term assets. Grant from other government, notice that are not specifically restricted for capital purposes. So another government giving you money, but they're not saying it's restricted for a specific purpose. Okay? Receipts from other funds, if you receive money from other funds, except, notice except, amount clearly attributable to the acquisition, construction, or improvement of capital asset. Because if they are, then they become capital financing activities. Now we're dealing with non-capital financing activities. And receipts from property and other tax collected from the governmental enterprise that are not specifically restricted for capital purposes. Again, those receipts from property and other taxes, they are not specifically restricted. Now the outflow, usually the outflow are the opposite of the inflow. Repayment of amount borrowed for non-capital purposes. Now you're paying back the loan, but the loan has nothing to do with capital purposes. Interest payment on amount borrowed for non-capital purposes. So you're making interest payment, but those payment on the loan was not for capital purposes. Grant to other government except for those specific activities that are considered to be operating. So you're given a grant, but it's for operating purposes. Cash paid to other funds except for interfund transfer dues. So those are non-capital financing activities outflow. Now we're going to be dealing with cash flow from capital and related finance. And capital means you are borrowing money or you are paying money for the purpose of acquiring assets. Now, proceeds from issuing bonds, notes, and other debt, notice here, for the acquisition, construction, or improvement of capital asset. Now, you're borrowing money, but the sole purpose, the main purpose is to acquire the asset. Capital grant, somebody gave you a grant, but it's specifically to buy an asset. Receipts from the sale of capital assets, so you sold a capital asset, and you receive the funds. Contribution from other funds, government, or other entities for acquiring, constructing, or improving capital assets. So there is a contribution but for the purpose of acquiring or improving a capital asset. Special assessment and property taxes to finance a capital asset. So you are imposing special taxes, and the revenue from those special taxes are clearly earmarked to buy an asset. The outflow would involve payment to acquire, construct, or improve a capital asset. The opposite. Now you are making payment for those capital assets. Repayment of capital debt, that's deal with capital debt means the debt was incur to buy a capital asset. Interest on capital debt, you are paying interest, but that debt was related to the acquisition or the construction of a capital asset. Okay. Cash flow from investing activities. Here we are dealing with investing, and here investing means it's investments. So what inflow comes from investments? Receipts from sale of marketable securities. So you had stocks, you had bonds, and you sold them. Interest and dividend received from investments. You received interest and dividend from investments. And this is, again, here interest is you receive the interest, and it's specifically from investments. Withdrawal from pool investments. So you took the money out from an investment pool. That's coming back to you. That's investments. Collection of loans made by the government, except for program loans. Outflow will be the opposite. The purchase of a marketable securities. Basically, now you're buying. The disbursement for loans. Now you are paying back the loan, except for program loan. And the deposit, now you're putting money back into the investment pool. And those are all considered, they are all considered outflow and investing activities. Okay, very similar to the investing activities for private, but remember, under for private, the investing activities would also involve long-term assets, which is what we call here capital asset. But for government, capital asset are like big deal. You know, capital asset are like basically, you know, financing and non-financing capital asset. Okay. Let's take a look at this quick example that's going to show us, hopefully we know where to categorize things. So let me just snip it here real quick, and maybe we can look at it. The following list of cash flow was taken from the statement of cash flow of this internal service fund, with all amount expressed in thousands. It doesn't matter. Cash on hand at the beginning of the year is 122. Now remember, we're going to have 4 categories. We're going to have operating, we're gonna have capital. Let's start with non-capital financing. We're gonna have capital financing, and we're gonna have investing. Those are the 4 categories, and obviously they most probably want us to classify them. Recast the list into the statement of cash flow, adding a line for cash on hand at the end of the year. Or basically they told us the beginning of the year is 122. Okay, let's go ahead and get started. So this is the beginning of the year cash. Interest from investments. So what type of activity is this? Well, interest from investments, that's his investment. So this is plus 45. That's an investing activity. That's done. Wages and salary paid, 3470. Obviously, that's paid. That's operating minus 3470. That's operating. Purchase of supplies, again, 1650. That's purchase of supplies. That's form of operating activities. Collection from other funds. Collection from other funds is 6380. Remember, collection from other funds, and notice what it says. It says for services. So be careful. Services means it's for operating activities. You provided the service plus 6380. Okay. Interest on long-term debt. Now, interest on long-term debt. Here they're not saying. I'm going to assume it's for capital financing. So this is going to be minus 150. So you paid interest, and here we're going to assume it's for capital financing. Interest is for capital financing. Again, it could be capital or non-capital. I'm going to assume it's for capital. Repayment of loans to other funds. Now you are paying loans to other funds. Notice you are paying a loan, so it's an outflow of cash. You are paying loan, but not for the acquisition. It's for other funds. Therefore, it's a non-capital financing. Negative 880. Negative 880. It goes under non-capital financing, so we're done with this. Purchase of capital asset, that's clearly it's a purchase of an asset, so therefore it's a capital financing. And if it's a purchasing, it's negative 900. You are purchasing an asset. Proceeds of revenue bonds. Here what you're doing is you have a bond, and you are getting the proceeds. You are raising money from the bond. Okay, so we're going to consider this capital financing activities. So this is, if it's proceeds, it's a plus. Proceeds, it's a plus. it's plus 800. Purchase of investments, this is clearly an investment, negative 400. If you're purchasing an investment, you are paying out, that's cash outflow. Proceeds from the sale of capital asset, you are selling a capital asset, so it's a capital thing, and it's under capital and financing related activities, that's plus 23. And proceeds from the sale of investments, now you are selling investments, you're going to be bringing money in, plus 33, plus 33. And loans from other funds. Again, loans from other funds, it has nothing to do with your, if they're giving you a loan, it doesn't say a capital financing, it's from other funds, therefore, and we're going to assume it's not capital financing. Now, obviously, we can net these out, 34,1650, that's plus 1260 from operating. This is negative 280. And this is 150 minus 1, 900 plus 800 plus 23. That's 227, negative 227 if my calculator is right. This is negative 280. And this is plus 45 minus 400 plus 33. That is minus 362. So let's net them out. So if we take all these numbers, we net them out, it should be plus 391, and our beginning cash was 122, so plus 122. So our ending cash will be 513. Our ending cash will be 513. Again, this, what I did is real quick, just identified each one, each category, and it's either plus or a minus. Hopefully this this exercise helped you with determining how to prepare a cash flow statement for an this is an internal service fund, but basically for proprietary funds. If you have any questions, any comments, by all means email me or see me in class, and this topic is covered on the CPA exam, so make sure